After years of rapidly rising prices, supercharged by ultra-low interest rates, Canada's housing market is in trouble. 2022 saw continuous price declines for two of the hottest markets in the country in Toronto and Vancouver. Where will 2023 take us when it comes to housing prices? And if you have been putting off buying, waiting for the right time, is 2023 the year for you? Well, let me tell you this. If you are a first-time buyer who's just been waiting on the sidelines, waiting to get into the housing market, or if you are a real estate investor looking to buy some properties, either add to your portfolio or start a new portfolio, have your down payments on standby. But when is the right time to deploy that cash? Well, let's talk about it. With average monthly prices contracting for the first time in 2022 after years of rapid increases, and the talks of another interest rate hike ahead, there's likely going to be more pain down the road. Now, with all that said, does that mean Canada's housing market is headed for a crash in 2023? The interest rate has gone from 0.25% all the way to 4.25%. And if the Bank of Canada raises interest rates in January, that interest rate can go from 4.25%, where it's at right now, to 4.5%, to maybe even 4.75% if there is a stretch increase of 50 basis points, because inflation is still running hot. Now, going back to that question, can a housing market crash happen in 2023? For a housing crash to happen, there needs to be a sudden drop in prices. Notice the key word there being sudden, meaning it needs to be almost unexpected. If you're sitting there waiting for a crash to happen, that's not really unexpected, is it? Now, last year on this time, I made a video warning Canadians not to buy a home in 2022. This was before the market even saw that first drop in prices or saw that first increase in interest rates. This was back when there were still bidding wars happening. People wanted to just drop in massive amounts of debt, take on as much debt as possible just to get into the housing market, because there were gains of 10, 5, 20% to be had. So if you were to talk about back then of pricing declines, you would just be laughed at, because the thought was that Canadian home prices can only go in one direction, that is up. And 2022 has proved everyone that prices can go down as well as up. The Canadian housing market is no different than any other housing market in the world. It can experience drops in prices like it has in the past. The problem is history. When you're too far removed from it, you forget. And look and behold, now we're here where prices have dropped every single month since February 2022. As much as I want to pat myself on the back for calling this out before it happened, my point is that housing prices are cyclical. They can go up, but they can also go down. And even during the massive price run-up that we saw in the last 10 years, if you were to just look at Alberta where prices were either down or flat. If you just think of the housing market as Toronto in isolation, or if you just think of the Vancouver housing market in isolation, that may change your view on the housing market as a whole. Look at the rest of the country. There are regional housing markets where prices can go up and down. Ask anyone living in Alberta. Prices have just recently started to rise because buyers have been priced out of Ontario. Buyers have been priced out of BC. There's rapid rising inflation. The cost of living just goes up each and every month. So if you want shelter, where do you go? Again, the point I'm trying to make is that housing prices are cyclical. After any period of slump, prices start to rise again. And over the long run, if you zoom out over 5, 10, 20, 30, 50 years, prices do go up over that long course. But the key is there are opportunities to be had on the way down and on the way up when you shorten the time frame. And one of the best ways to keep up with our housing market of what's happening, our prices going up, our prices going down, should you be buying, should you be waiting? All you have to do is hit that like, subscribe, and thanks button on the bottom of this video so you get notified when there is future content on housing market updates. Housing prices are largely cyclical and should be in line with the broader economy. And a key aspect to this is that a large portion of one's wealth is tied to the value of your home, assuming you already own your own home. And your home is likely the largest asset you have on your personal balance sheet. So when the economy hits a snag and there are talk of recessionary factors such as job losses, when people lose their jobs in masses, this leads to lower overall income levels, which ultimately limits the pool of buyers available for house hunting. Think about it. If you lose your job, you're not thinking of upgrading your own home. You're thinking of protecting your cash flow because of that uncertainty around the job market. So this is what causes prices to decline, which when you have a lower pool of buyers and people are selling their homes because they can no longer afford it, that creates a drop in pricing. When a recession occurs, housing prices start to fall. And that hurts the confidence among homeowners, which forces them to really look at where their dollars are coming from and where their dollars are going. This aspect then leads to further contraction in the economy because people are just spending less to protect their cash flow. When they spend less, this hurts the economy. This contracts the economy even further, which also then contracts the housing prices. I'm sure as you're watching this video, you likely have someone in your network that may have recently lost their job, or the company they work for is going through layoffs, or maybe the layoffs are happening where you work. This is a tough time right now where companies are trying to protect their cash flows going into a recession. And when companies want to cut back on spending to make sure that they can protect their cash flows, one of the quickest ways to accomplish that is by a reduction in their workforce. Because the biggest expense for most companies, especially tech companies, is people. 60 to 70% of the cost of any tech company or an overall generic tech company is labor cost, is the cost of software engineers, is the cost of developers, is cost of people in the marketing department, finance, and so on. It's the labor pool. And that's why when companies are going to cut back, they go through these periods of layoffs. A real estate crash then follows after you have periods of aggressive price increases, which is defined as a bubble. As I'm saying this, there are two cities that I'm thinking of that went through aggressive price increases in the last few years. Toronto and Vancouver should jump out to you at this point. Activities like speculative buying, housing flipping, the Brampton loans, or setting rock bottom interest rates pushes prices higher than what the rational market dictates those prices should be. Now, this concept is a little bit different compared to prices rising due to low supply, which is a more pervasive issue in nature and needs targeted government policies to address. Rapidly rising interest rates can trigger a housing crash because they add an extra layer of cost in owning your home. Interest rates are set by the central banks like the Bank of Canada, which will ultimately influence the mortgage you have to pay, which is set by your lending institution. Now, how does all this work? Well, when interest rates go up because the Bank of Canada is trying to control inflation because there's so much cheap money around, is to discourage spending. One way to discourage spending is to make things more artificially expensive by increasing the cost of borrowing. This larger cost of borrowing goes to your mortgage payment, which has two components, the interest and the principal. The interest all of a sudden starts to balloon up, lowering the principal portion. Now it's making it even more expensive to service that debt. When that payment can no longer just take the burden of the interest rates, the amount of mortgage you have to pay may increase to just contain and just to cover the interest component. Now your income hasn't gone up, but your mortgage has gone up. People may have limited options in that scenario because if your income hasn't gone up and you can no longer afford your mortgage, you have limited options. In this case, you may be forced to sell your home. If this happens in masses where more people are going through the exact same situation where their income hasn't gone up, but their mortgage has gone up, they are also forced to sell. This adds more and more supply to the housing market, and we're starting to see parts of this trickle through. It doesn't just affect homeowners when they are forced to sell. Home buyers are now even more limited because they get less of a mortgage. This limits the pool of buyers. So you have homeowners who can't afford their homes, so they are putting their homes on the market. You have buyers who can't afford to get a mortgage to buy that home. What does that do? More homes are coming, pool of suppliers is limited, that causes prices to fall. Rising interest rates are intended to slow down the economy because the economy is just running way too hot because of inflation. It discourages spending. It discourages investing. It hurts income levels. It hurts the confidence in buying a home. When you take a look at the history of housing crashes, any analyst or any person talking about the housing market crash will quickly point out the period of 2000s. During the US subprime crisis of 2007-2008, this triggered a massive global recession. And during this time period when interest rates were forced to go up, many people, they simply could not afford their homes. This led to foreclosures. This led to many people selling their homes because they needed cash and they just simply couldn't afford their home. This proved that the market was irrationally inflated. And it's because of what happened in the US in 2007-2008. That's why many analysts or many experts or anyone talking about the real estate market will compare that period to what's happening in Canada today. It's not just the rising interest rates. It's not just the economy. It's the fact that if people can't afford their own homes, if you can't afford the home you live in, you are forced to sell. Then it goes back to a simple supply and demand. If there's too much supply coming into the market because people can't afford it, buyers are limited, this naturally depresses prices until buyers can start to afford those homes. Now going back to that ultimate question that I started at the beginning of the video, can a housing market crash happen in 2023? It can absolutely happen because of these rapidly rising interest rates. The key here really depends on your ability to carry on a mortgage at the current interest rates. Not at the current interest rates, but also have room to carry on that mortgage at higher interest rates if they continue to rise. Just like in the US, when people could not afford their mortgages and they were forced to sell in masses, this creates that domino effect for prices to come crashing down. This also distorts the confidence for buyers and for sellers to a significant extent for years to come. And that's why following a period of crash, prices are typically stable or flat because people are worried, what happens if another crash happens? What if I lose my home again? So this makes people more cautious of their spending. But when you have a period of rapidly rising prices, when homes are selling like hotcakes, people do whatever it takes to just buy a home because they think that ride goes on forever. This is a rude awakening if you've never experienced a housing price crash. Inflation right now is currently sitting just shy of 7% and hasn't changed all that much since August of 2022. Let's take a look at this quote from the Bank of Canada. Although they have paused rate hikes for now, but until inflation comes down to their target range of 2%, rates will likely rise further. The impact of these rising interest rates is now apparent. It's in your face. The average selling price of a home in Canada is down 12% year over year. In Vancouver, prices are down nearly 11% compared to their all-time highs. And in Toronto, prices are down 10% on a year-over-year basis. And there are no signs of this trend reversing anytime soon. This pricing decline is just a drop in a bucket compared to the 12 years of price increases that these two areas have seen. The fact is that home prices today are still disconnected from income levels and from rents, and they have been for a really long time now. Let's say if the benchmark prices were to fall 30%, this will only take us back to February of 2020, which was pre-COVID. And if memory serves correctly, prices were not all that affordable back then either. But let's say the scenario pans out and prices do fall another 30% and we go back to where prices were in February 2020. But now, this time, their interest rates are much higher, making it even more unaffordable compared to what we saw in February 2020 with lower interest rates. Canada's housing market is correcting quickly, much quicker than anyone had predicted, especially when you take a look at the heavily populated areas of BC and Ontario. They are seeing the worst of it. Here's a quick example to make that point. If you are on any pre-construction distribution list, you've likely seen the developers are now cutting back on prices. They're offering discounts of $20,000, $30,000, $40,000, $50,000 because homes are no longer selling. So they're claiming discounts on prices just to get you in the door. When I get asked, what do I expect from the housing market going into 2023? My response, expect prices to fall further, especially in provinces that saw the largest price gains during the pandemic. And if you've been following my channel, if you've been following my content, you know which provinces I'm talking about. Now here's something else to throw at you. If the recession hits Canada harder than expected, the Bank of Canada may be forced to reverse their course on interest rates. And if these events line up the way it's looking, that means for Canada's housing market, prices should stabilize late 2023. And once it stabilizes, the market should be more balanced and a little bit more sustainable going forward. So if you are a prospective buyer who wants to get into the housing market, or if you are a prospective investor who wants to scoop up rental properties, do not take your eyes off these dominoes that we just talked about. The panic may be still sticking around, but people are still catching code. But the era of the housing market boom is definitely over. So does that mean now all signs are pointing to a Canadian housing market crash? Thanks to a huge growth in population and stubbornly low supply, especially in the heavily populated areas of Toronto and Vancouver. The general consensus is that the market prices are expected to stay above pre-pandemic levels in the near term. Now, here's the thing about any forecast or any prediction. They can be wrong. A forecast or prediction is just based on a series of events happening in the expected way. If ABC happens, then this happens. But if ABC doesn't happen in that same exact way, those predictions, those forecasts go out the window. My point is, don't take any forecast, any prediction like a hard, cold truth. It's just a guess based on what may happen. It's not substitution for your own research. And as always, when you invest your money or you're moving your money around, make sure you do your due diligence. Make sure you do your research to understand what's happening behind the scenes. Don't just take the word of any talking head as the absolute truth. Nobody has a crystal ball. I don't have a crystal ball. I'm just telling you what may happen based on certain economic factors if they line up in that exact way. Just remember, past performance is not an indicator of future results. And never put money down on anything, on any investment, on any house, or any property that you cannot afford to lose. Thank you so much for watching and making it to the tail end of this video. I have exclusive offers for you in the description of this video for products and services that I use on a daily basis. So do me a favor, check them out. Maybe you find something that you like. And don't forget, make sure you hit that like, subscribe, and thanks button so you don't miss out on future content. That's it for now. I'll talk to you in the comments section.